All right, guys, here we go. Let's get straight into it. This is the box-in trading plan. So these are the written rules for the plan for you to follow and trade by. So we're gonna go over the trading plan followed by the checklist. The trading plan is designed for you to have a guideline, a system, and the structure for you to follow. Once you start applying this on a daily basis, you're basically going to have this committed to memory. It's really not that complicated. But once you start applying it, you're going to start to see results similar to the ones I am about to demonstrate on the following videos. And this is how the plan goes. Okay, so let's get straight into it. These are the rules for the plan, guys. We're going to keep it simple. Rule number one, stay in control. This is key. This is why I went over the daily routine and making sure you are in the right mental state, right mental attitude, and ready to initiate trades and make positive and good decisions for you, your accounts, and your life. So you need to make sure you stay in control. If you know you're not going to be in control, you're tired, you're stressed, depressed, or anything that ends with est, that's not making you feel well, guys. Make sure you stay out of the markets. Do not trade when you are not in the right mental state. It is imperative that you pay attention to how you're feeling, physically, mentally, and stay out of it. Okay. Second, we're gonna stick to the plan. You have a plan. Follow it. It's there for a reason. A lot of reasons why we fail when we first get started, is because we don't have a plan. Like I mentioned before, how I started trade. I used to trade just to trade, and I was up $3,000 one day, and again, ended up losing 4,400 for the day because I made $3,000 in about 15 to 20 minutes. I was like, oh, this is easy. Let me keep doing it. Maybe I'll make more. Had no rhyme or reason to keep trading after I had already made a decent profit for the day. But since I didn't have a plan to stick to, referring to me, hey, what my target was for the day, or how many trades to take, or whatever, I basically just kept trading until I lost all the money, until the pain was just unbearable and I had to just stop. So, and that's what it was. You have to make sure you have a plan that you follow so that you know when you need to stop, okay? Rule number 3 is never break rules 1 and 2. And that's as simple as that. Stay in control and stick to the plan. 3, do not break rules 1 and 2. If you're out of control, you find yourself wishing, hoping, and praying for something to come your way, get out. That's it. You're not in control when you're in that situation. You're either over leveraged, or you're not confident in your decision because it was an impulse trade, or you jumped in because of an alert, a stream, something you saw on YouTube, on the news, whatever the case. If you didn't jump into this trade by your own volition, because you found it, you liked it, you know what I mean? It was not a good trade for you to be taking, and you're not in control of it because you don't know why you entered, okay? And then obviously don't break rule number 2 again, because you need to stick to the plan. All right, moving on. Let's get straight into our trading rules. So number 1, as I mentioned before, we are going to do our daily analysis. We're going to go over our daily goal and risk, so that we know what numbers we're looking to stay in between or above. So when it comes to the goal, we want to stay at or above the 1%, if able. And the risk, we're also going to try to stay at or below our 5% for the max when we're starting with a small account, and our 1.5%. Actually, we want to stay at a 1.5%, but no more than the 5% if it gets away from us, okay? Do not let it go beyond that 5%. If you see it got away from you, do not say, oh, it'll come back. No, it's probably not going to come back. Do not fight the market. You can always get back in. So just stop the pain. The only way to stop bleeding is by stopping the blood loss. Okay, so if you're going to stop it, you got to, cauterize the wound and make sure you stop that bleeding. So stop it, okay? So you're going to go ahead and on your goal tracker sheet, as we reviewed before, you're going to go ahead and enter your previous day's gains and the number of trades so that your numbers are updated. And keep in mind the day's goal and the 5% number, as I mentioned before, okay? 2, we're going to analyze the bigger picture. Every single day, you will analyze the bigger picture. Take a look at the weekly, take a look at the daily candle for the stocks that you're looking to trade, and even the markets. Just pay attention to what's really going on behind the scenes. So that you can pay attention to the longer term trend. And obviously, what is that going to tell you? So what are we looking for? Which way is it trending? Is it forming a reversal pattern or is it a continuation? Okay. Is it near support or resistance? So you want to pay attention to those things. So analyze your risk. What are we looking for? What is the target for this trade? So if you're looking to trade Amazon, right? You want to make sure Amazon, it's a trade that you can handle. So one, you want to look at your limit order, where you're looking for it to return to. So if it's going to be a reversal play and you're looking for it to return, let's say it's at 1800 and you're looking for it to go to 1750, you need to look at that. And it's like, okay, how much will you make? And then what is your stop? So if it is a reversal pattern, are you getting out at the peak of the day when it breaks above that peak, and can your account handle that? So you need to analyze that. Okay, so what is your target and your stop, and how much can I put to work on this? So again, this is referring to, can the account handle the move? If your account can't handle the trade, do not take the trade. Okay, so this is when it's important to start getting familiar with that analyze tab. Don't rush into any trade. Take your time analyzing it. As the account gets bigger, you'll actually get better and better at this, and you'll be able to do some quick analysis. Just by looking at the chart, you'll know that it is within your risk tolerance. Just by seeing, okay, this is only a 50-cent stop, $1, $2, $5 stop. This is within my risk tolerance. You'll know that when you're layering in, if you only got 1 or 2 contracts, you'll know, hey, when it gets here, I know I'll lose about 50 cents to $1 on that options contract. I know that's within my tolerance. And that's especially why I always say get in the money puts or calls when you're initiating, because they will retain value a lot better than those out of the money ones, okay? So again, use the analysis tab to review your trades, and start practicing on finding the best structure available. If you have a cash account, you may only be able to do single puts and calls. So obviously, as the account grows and you get over to a margin account over PDT at 25, we'll start covering more and more advanced strategies, especially on the upcoming courses for mastering execution, advanced strategies, and the stuff that I release for free on YouTube. Obviously, I'm always going to be covering all that stuff. But as I catch it live, I will update those and upload them as much as I can, guys. Okay. All right. So let's go over before we enter. So before we enter, guys, let's take a look at what we need to look at. So what are the market internals telling us? And again, the market internals we like to look at are the tick. Okay. We have the VIX. And one secret sauce one is the trend. Okay. And I'll cover that one in the chart setup course. Obviously, you guys saw how we have the trend. And then, obviously, we have the 4 markets I like to monitor. So I like to monitor the S&P, the E-minis, the NASDAQ, so the NQs, and the Dow minis, right? So these are the ones I like to cover personally. So what you want to do is make sure that these internals are telling you what is likely to happen next. So where did the tick open and where is it trending now? Did it open below minus 500 or above plus 500? It kind of tells you where that selling or buying pressure is. Did it open in near zero? Are we going to have a choppy day? What is the VIX doing? Is it moving higher or is it moving lower? And remember that the VIX is a contrarian signal to the market. So when the VIX and the markets are going in the same direction, that tells you that there is divergence between the two. And basically what you're going to notice is that when the VIX and the markets are both going up, the VIX will tend to win. Or vice versa. The VIX is going down and the markets are going down. You're going to notice the VIX will actually win and the markets are due to pull back, and probably pull back a little bit harder than normal, okay? What kind of volume do we have on the markets? I particularly like to measure the Dow minis, so you can measure whichever one you want. Honestly, it doesn't matter as long as you're measuring something. For me, I like to use the Dow, as I've mentioned before, because it's an easier number to keep an eye on. So I've noticed that it likes to trend around 45,000. But when it opens below this, you tend to see less significant moves and or choppy days. Above this, especially if you get a day like over 60 or 70,000, you're probably going to have a significant day when you get massive volume on the pre-market, okay? And then before you enter, we're going to focus on 2 stocks at most for the day, guys. This is a key part of this plan, okay? Do not exceed 2 stocks per day. It's going to make your life a lot easier to manage. And even if you keep it down to 1, you'll notice that Pretty much on this case study, I only stuck to one or two per day for that reason. It's a lot easier to manage one or two than it is to manage three, four, five, or six, because you don't want to miss something. You have that fear of missing out. If you feel like you're going to miss out on something, get out of one of the ones that you don't like because it's not working and jump into one of those. But what you're going to tend to notice is it's kind of like jumping the line at the grocery store or the supermarket. You know, you're at this cashier, there's this cashier and this cashier, and you have two people in front of you here. You have one person here, two people here, and then you move over here thinking, oh, this is going to go faster, but this guy has a fuller cart, and these people are gone. So now you have one person that came in behind you, and now you want to come behind this person. Now this person's taking forever, and this person's gone. Now this line is completely empty. Now you see this line is empty, so you move over here, but somebody gets in front of you. And that's exactly what it is, guys. You don't want to be jumping back and forth. Stick to your plan. Trade one or two. There's always going to be more and more opportunity. You do not have to rush or feel like you're missing out. It's okay. You know what? You missed out. Oh well. Next time, keep an eye on that stock. Look for signs that could have told you, man, if I would have kept an eye or an alert on this, I wouldn't have missed that on that. So that's what you want to do. That's why I said set alerts, because you can't keep an eye on everything. It's impossible. You know, that's why I have my charts with 5 different symbols loaded at any given time, so that I can kind of keep a quick eye on them for my peripherals. You know, I can see, hey, this one is moving. Let me see if I can catch it. And setting your alerts, because sometimes you change those charts. But if you set an alert, you won't miss it because you've boxed it in already. And once you've boxed it in, now you know that, hey, this is moving while the other ones are not, or they're stuck in a range. So that's the purpose of setting alerts, okay? All right, so conditions to consider. If the tick opens between minus 250 and 250, and the candles on the 5-minute stays in that range, it'll probably be a choppy day, reinforced if the 9:35 candle repeats. And by 9:35, it's on the Eastern Standard Time, guys. I know not everybody's on the same, so obviously 5 minutes after the market opens is what I'm referring to. So if the first two 5-minute candles on the tick stay within that range, it is likely to be a choppy day. So what does that tell me? Hey, I may not want to trade today, or I may want to wait for a better setup based off a pattern, not off of a break of the pivot, or not on a break of a pre-market high or low. Okay, so when you have an opening of in this range, you want to stay away from the box-in method and trade it based on a pattern. Okay. So those are the conditions you want to consider when it comes to the tick. Also, you want to look at, are there any expected news events that may keep people out of the markets, i.e. FOMC meetings, Fed minutes, president talks, war announcements. Stay away until after the events. If you see low volume, and because we're expecting some kind of announcement to happen, just stay away. It's just safer. That way you don't get stuck and your options don't start to lose value if you just did a regular single put or call, okay? How heavy is the volume on the markets? Again, I'm referring to the volume because of this. Recorded daily, and always recorded daily for the pre-market, okay? Recorded daily. You're going to start to notice trends, and you're going to be able to kind of make better predictions as to what you're expecting the day to behave based on this pre-market volume, okay? So let's get into our entry plan, okay? So first of all, we're always going to enter on good patterns. And best patterns to focus on are, for obviously, since we're doing the boxing, we're going to do the breaks of the pre-market low or pre-market high. And only valid when broken within 15 minutes. This is key. I don't think I've mentioned this before. The boxing strategy is only valid when you do it based off a break between the first 15 minutes of the market open. If the break happens at 9:50, 10 o'clock, 11 o'clock in the morning, that is no longer a valid reason to take a boxing trade. You're stuck in a chop, and what most likely happens when the break happens later in the day or in the morning. So this is a 9:30 candle, 9:40 candle, 9:50 candle, and then at 10 o'clock you get a break lower. What happens is usually a fake out, and then it reverses back into this range, and then you get stuck in that range. Meanwhile, your contracts are losing value. So you need to make sure that you are only jumping into the box-in strategy based off a break within the first 15 minutes. And I do have a perfect example of this. It was actually our best trade for the 7 days, and it was an Amazon trade based on a doji that formed up. So basically what happened was and you'll see the trade when we start doing those reviews. Amazon was stuck in a range. It never failed. It never broke out of the range. So once it formed a nice pattern, and I was like, oh, you know what? It looks like it may reverse back down to that lower side of the range. I took the trade on the top when I saw a pattern. And luckily for me, it actually broke down even further than that. So I ended up doing pretty well. So now, all right, second best entry patterns I personally like are evening stars, morning stars, shooting stars, dojis, bullish and bearish engulfing hammers, inverted hammers. Obviously, there's a ton of patterns, guys, and you have the sheet I've shared with you guys if you're already on our Discord group, free community. So you can use this sheet. You can find your own sheet. You can find whatever you like, as long as you have some kind of pattern or a reference that you know what to look for. Obviously, you're not looking at these all the time. You'll kind of just know what the patterns look like. The more you're trading, as you can see, everybody names their patterns differently, and just like look at all these mornings. You got morning star here. I thought this is the evening star, but they call it Southern Cross. It doesn't matter. The name is irrelevant as long as you understand what it is and what the patterns look like. So hammer, there's a ton of different names. Here's another one here. This actually is pretty nice and clean. It looks more like a real candles instead of these ones that look like they were made. But either way, as long as you know what the patterns look like, you want to start paying attention to these and jumping in based on good patterns. Obviously, matching everything else up. So always looking at the market internals. Always looking at the VIX, the tick, okay? And now, as you can see here, some of these tell you, hey, once this happens, you're going to sell here. Once this happens, you're going to sell here. I personally like to, for example, on evening stars or morning stars, or hammers, I like to get in on the actual pattern. Pretty much when the pattern is building or right before the candle closes, because my stop is going to be a tight stop over here, right? And the reason I like to do that is, guys, because I'm layering in. And this is why I emphasize making sure you layer/scale into your trades. Don't jump in all at once. Why? Because if you only got one contract here, right? And then this one starts to go your way, this is a perfect indicator. Yes, okay, go ahead and sell here once it breaks this level. This is the level where you want to start adding. So if you added one at the top, you're risking very minimal dollars when your stop is the high of that candle. So when you're looking at that, you're going to say, okay, well, let me jump in. You're risking pennies, literally cents on that move, depending on the stock, obviously. But you're risking minimal amount of money. And then once the move is confirmed, boom, you go ahead and layer in some more. Once you get a breakdown like this, right? Now you're profiting a lot of money because you layered in, but then you can let the single one that was deep in the money, you can let that one run a little bit longer. And that's the benefit of layering in. So you can take off the big position at your targets. Let's say this is the pivot, but you can let the other one run just in case it runs. And when it doesn't run, let's say it starts to reverse and you get stopped out here, you're still making money. It doesn't matter. But that way you let your winners run, because you don't want to take all your profits and then something like this happens here, where you jumped in at the top and you took your profits here for all of them. Yeah, it bounced up a little bit, but then it continued lower and it went significantly lower and you couldn't profit. So this is key to letting your winners run. And there is no problem with taking profits, guys. If you know, slow, consistent gains are gains nonetheless. So it does not matter, but you do need to get into the habit and being comfortable with taking profits and also letting your winners run, okay? So let's go back over here to our entry plan. Do not force the trade. If it got away from you, fine, it got away from you. Do not force a trade. Do not chase it. The thing you're going to notice is every time you chase, you're going to end up overpaying for things. And instantly you chased it and it's going to reverse on you, which is why it's important to pay attention to market internals and your indicators, i.e. the RSI, which will tell you, hey, this is probably due for a pullback soon. Always obey the pivots over the pre-market conditions. What I mean by this is if you find yourself to be near the pivots, the pre-market to be near the pivot, the pivot is going to overrule the pre-market highs and pre-market lows, okay? It's just the pivots are a little bit stronger than those pre-market highs and lows, so you will always use those over the pre-market highs and lows, okay? Wait for patterns, compare 10 to 30 minute charts, okay? So when you're jumping into a trade, always look at what the larger time frame is doing, and make sure it kind of confirms the expected move. One thing I like to look at is the RSI. So take a look here. When we're looking at these two charts, what you're looking at is that the RSI is confirming that, hey, we are overbought and or oversold on both time frames. Usually you'll notice that this RSI will be indicated the same all the way from the 5-minute to the 30-minute chart, if not higher. And that's the conditions I want to look for before I jump into a reversal play. Okay, so wait for the RSI indication before entering. If you missed it, just wait. Avoid FOMO. Do not jump into a trade if you missed it. Just wait for the pullback, wait for the bounce, whatever the case, just wait for it, okay? And then lastly, if the daily and the market support continuation or reversal, move it. It is best to wait for a good pattern in that direction instead of fighting the markets. So what do I mean by this, guys? If the market is supporting an uptrend and you see that the stock you're looking to trade, SPY, Amazon, Nvidia, Tesla, is going lower, it's best to wait for a pattern for it to say, hey, we have a morning star, a hammer, and wait for that reversal pattern for you to go higher. I actually have one example of that where I actually ended up taking the trade in the wrong direction because the volume just came in so strong that I was like, oh man, we're going to go down. And obviously I always say remain objective, but this is one of the reasons why we're always paying attention to the higher time frames. You want to go where the market wants to go. You want to go where the stock wants to go. And if that stock wants to go higher, that's the direction you want to be going in. Okay, so this is why you're paying attention to that. So let's go ahead and continue here. All right, so layer into your positions. And what do I mean by this? You're going to layer into your positions so that way you're not risking your max dollars right from the beginning. So upon identifying a pattern formation, determine your max risk for the trade. So whether you're going to use 5% of your account, 10%, 20, or 30% to jump into the trade, break that down into chunks. So that you can do 1/5 of the position, or you're gonna do 1/3 of the position, however you want to layer in. I personally like to recommend the 1, 2, 3, 4 method, 2, 3, 5 method. But again, let's say your total position size once the account gets bigger is gonna be 20 contracts. You can do 5, 5, and 5. You can do 4, 4, and 4. You can do a combination where you do 2, 3, 5, 5, and 5. The point is that you need to layer in. Do not jump in all at once. And I got to ask this question on one of the coaching calls where it's like, well, why not jump in all at once? Won't you make more money? Yes, you will make more money if it goes your way. But do you really know for sure that it's going to go 100% your way? Nobody really knows. We can only trade what we see. So when we're trading what we see, let's say I see a morning star, the stock has been falling. And now I have a reversal pattern here. I want to go ahead and add a small size of my full position here. Why? Because yes, even though it's forming the patterns fail all the time, guys. Patterns fail all the time. And yes, it could initially start, open here, gapped open. It went higher. I'm like, oh yes, this is going my way. But what happens next? Instantly, it breaks down, guys, and it starts to go lower. And that happens all the time. So you don't want to be in your full position at this point here, because what happens? You're going to lose all your money. Why? The position failed as soon as it broke through this level here. Okay? So once it broke through this level here and it closed below it, that's it. You're done. So if you went all in, now you just lost a bigger chunk. And as opposed to losing a small position, maybe 30, 40, 50, or $100, you just lost $500 to $1,000 because you went all in. There's no need for it. There is no shame in paying a little bit more for something once it goes your way. It's just the way it is. Yeah, you've heard average down. No, you can average up too. You can average up. It's fine. It's just the way to go. And then you can just let the winners or the ones that are more deep in the money run a little bit longer. So you can get a strike here in the money. But when you get up and you start adding here, for example, you can just get another strike. You don't have to do all at the same strike. So now you can buy another strike that's pretty much at the same delta that this was at when you first got into it, and now you can just buy two of this one. You bought one here, now you add two, and then when you get another up candle, you can say, you know what, this looks as it's going to be strong, the volume is coming in, supporting my direction, market internals are supporting my direction, I'm going to go ahead and add 3, 4, or 5 here, whatever the case. And that's how you want to layer into your positions, okay? So on the 10-minute candles, wait for the close of the candle or right before the close. So when you're going to get into your position, like I said before, I want to get in when the pattern is forming, or right after it forms, right on the very next candle. I don't want to wait too long because I want to get the best price on my initial entry. Let the position confirm that it's going my way. But even so, I want to get in here because, again, my stop is going to be here. If I wait for the close of the next candle, now I'm further away from my stop, which is going to cause more pain if it does turn around on me, okay? So this is why I say wait for the close to the end of the candle to jump in and or get out, especially when you're doing your stops, okay? You don't want to get squeezed out on a fake out. When the initial pattern forms, enter the first layer, 1 or 2 contracts. I've already went over that. On the next candle pattern confirmation, add the next layer or layers. Always submit initial entries below mid or at the bid. Try different in the money strikes. This is key, guys. This is another one of those things. You'll be surprised how often you get filled at the bid. I'm serious. The bid, you will get filled. You will get filled at the bid more times than you realize. You just have to obviously try. And if you go over any options chain and you scroll down to the bottom, you'll see how many times people got filled at the bid. If you just put in a bid order, you'll get filled at it. So there's no shame in trying to get filled at the bid. You want to get better pricing. So always try to submit a bid order first and let the sellers come to you, not the other way around. People are always trying to get out of their trades as well. Don't forget that. So always submit your bid orders, at the bid first and or between the bid and the mid before you go in and do the mid right from the beginning, okay? And last but not least, let's go over our exit plan. All right, so we're going to always have a stop and limit in mind before taking the trade. I've said it before, I don't actually set physical stops, guys. They will come for your stops. Almost guaranteed they will come for your stop. They will spike up or down to get your stop if you actually set a physical stop. So I personally don't set them. I just keep an eye on that level. I set an alert and I monitor and wait and I follow the plan, which is, hey, if it breaks above and closes above my stop, I'm going to get out. And limit in mind before taking the trade. So again, you need to have a target before you take the trade. Where do you think is it going? Based on your analysis, is it going to be the next pivot, the next support or resistance area? Keep those levels in mind, okay? So when entering on pre-market breaks high or low, set stop to a close above or below the pre-market high or low of the nearest pivot. Okay, so if you're looking at this chart here, take a look. So this is the pre-market high, this is the pre-market low. We're going to set our stop if we're going high. On this case, we're going to go and set our stop at the pre-market low. Alternatively, if the pivot is too close or is the pre-market low or high, you're going to set your stop at that pivot, okay? Which is going to be the case in a lot of times. You're going to see that the pivots are going to actually end up being your stops. Number 2, upon the close of the 9:30 candle on the 30 minutes, okay, 30-minute chart, move your stop to the close above or below the high or low of that candle, depending on which way we're going. So if we're going higher, you're going to move your stop to the 30-minute candle low unless the pivot is that low. You're going to obey the pivot above the low, okay? Follow the 30-minute candles up or down with your stop. That way, your stop is going to be, if you don't hit your limit, whether it's the pivot or resistance or support area, you're going to follow it along with your 30-minute stop. Every 30 minutes, you're going to move your stop. Do not move your stops down. If you're following your trade with the candles and the first 30-minute stop is here, the second is here, and then say the third peaks below here, but it never really stopped you out here because it never really closed there, you do not move your stop down. You keep your stop up here, okay, guys? You'll see that happen occasionally. Do not move your stops down. Once you moved it up, just keep it where it was. Target pivots. Okay, so target the pivots or next support resistance as initial profit taking areas. So again, always take your profits at these pivots, near, at, above or right below the pivots. These are really, really good areas to start taking profits, at least on part of your position, if not all of it, depending on how much of it you have. If you only have one contract, go ahead and lock in your profits for the day. So part of the plan for this plan is to lock in profits every day. You want to lock in at least 1%. That's the goal. So the reason is you want to have consistent gains and growth on the account, because you need to have a bigger account. And if the account is not growing, you won't be able to take larger trades as the account goes. So you need to lock in those profits every day so that you can take on more trades and layer in more as the time goes on. So every day, the goal is to lock in at least 1%. You're going to notice that you're going to actually lock in more than that most days. And then the days that you do lose, you're losing less than what you actually locked in if you're following the plan. Always review the patterns being set on the daily before the end of the day. The main reason for this is you want to know if this is going to be a stock that you're looking to trade tomorrow. You know, are we forming a reversal pattern or are we forming a continuation pattern? Okay, and you're going to write down where the RSI is for the day. So if the RSI starts to break above 80, like I've shown on the scans, you know, you're going to see that you want to write these down and keep an eye on it until you see a pattern forming. Once a pattern forms, you're going to be able to take that trade, okay? And lastly, if the daily supports a continued move, hold a small mid-sized position for continued rally or sell-off if you layered in. This is only valid if you layered in. If you didn't layer in, then you are just going to get out, okay? And okay, exit plan for entry on candle patterns is set the stop at the high or low of the day or that pattern formation. So if you got in on an evening doji, shooting star, hammer, whatever the case, you know, you're going to make your stop. It's going to be a tight stop. It's just going to be a close above that, because that means the pattern failed, guys. If the pattern fails, admit it to yourself. You're only lying to yourself if you think it's going to come down. Get out. And yes, it may break higher. Once it closes above here, it closes above your stop, you need to get out. Yes, the next candle may very well set up another pattern or very well reverse. You can always get back in. You know, you can always get back in. Personally, I would say don't. Just move on. That's it. It failed. Don't start putting more money trying to chase it or have a revenge play. Do not do revenge plays. That is not part of the plan, okay? You enter on good patterns and you get out. You obey the stops, okay? So at this point, just don't chase it. Don't bother again with the same stock unless you see another good pattern. Don't just get in randomly. But again, you're only focusing on 1 to 2 stocks per day, and your trading times are most of the time are really going to be 9:30 to 11, and you should be done by 11 just about every day. And then if we're doing end of day plays, based on patterns on the end of the day, you're looking to start entering positions anywhere between 3 and 4 o'clock for the next day. Okay, but on this case studies, we're only doing the morning sessions, for the reason being that we're doing the box-in strategy and door pattern formations, and that's it, guys. You do not want to chase or get back into something because you lost a little bit of money. Okay, you lost a little bit of money. Thank God it was only a little bit. Leave it alone. Do not do revenge plays. Okay. All right, same as in the boxing, you're gonna move your stops based off the 30-minute candles highs or lows. Target the pivots or the low of the range if it's stuck in a range to take profit. Lock in profits daily. Remember your 1%. Always review patterns being set on the daily before the end of the day. If the daily supports a continued move, hold a small to mid-sized position. Okay? So that's pretty much it for the trading plan, guys. Make sure you have your PDF version of this so that you can review it until you pretty much have it committed to memory. This structure is going to help you, and I'm going to demonstrate it in action so that you can see how it actually works. And once you apply it, you're going to see consistent gains on your account, okay? So I'll see you guys on the next video, and let's get started.